Hello, welcome to Eunice Financial Academy. So in this video, we are going to look at the basic concepts of accounting. So here we are going to look at the definition of accounting. We are going to look at the basic or the golden rules of accounting. We are going to look at the accounting procedures and elements of the financial statement. So please, you follow up. In case of any doubt or question, you drop it at the comment section. I will get to you later. Please don't also forget to like, share, and subscribe. Thank you. So what is accounting? Accounting is a process of recording financial transactions pertaining to a business. So these processes include reporting, recording, interpreting, and summarizing financial transactions into a meaningful format. So you need to understand that accounting plays a major role in financial stability and also for us to achieve our financial goals, like from creating a budget to analyzing expenses and also making investment decisions. We need some important accounting principles to guide us so that we can arrive at a meaningful format. So you also need to understand that accounting is not just kept for decision making, it is also kept for legal and tax purposes. So in order for us to arrive at this meaningful format or accounting format, there are some rules that we need to follow in accounting, and we call them the golden rules in accounting. So there are three main golden rules in accounting. But before we go into the golden rules of accounting, you need to understand that accounting evolved around debit and credit. Debit and credit are equal but opposite entries in accounting books. Debit and credit affects the five core types of accounts like the asset account, the expense account, liability, equity, and the revenue account. So the first golden rule says debit what comes in and credit what goes out. This is mostly for re-accounts. What are re-accounts? Re-accounts are accounts that don't close at the end of the year. Instead, their balances are carried over to the next accounting period, like the asset account, the liability account, or the equity account. So the next golden rule says debit all expenses and losses and credit all gains and income. This is where the nominal account comes in place. Nominal accounts are accounts that close at the end of each accounting period. So at the end of each accounting period, all the expenses and losses are being debited and the income and gains are credited. So the last golden rule says debit the receiver and credit the giver. This is mostly for personal accounts like general ledger accounts that pertains to individual or organizations. So these are the golden rules in accounting. So you need to also understand that debit is an entry made on the left hand side of an account and it increases the assets and the expense side of the account and decreases the equity and liability or the revenue account. And then the credit is an entry on the right hand side of an account. It increases the liability, the equity, and the revenue account and decreases the assets and the expense account. So our next topic is accounting procedures. Accounting procedures are the steps from recording business transactions to generate financial statement for an accounting period. So we have the source document. The source document is mainly an evidence that proves that a transaction was being carried out, like an invoice, receipt bills, and statement or any document that shows that a transaction was carried out is a source document. And also remember that anytime a business receive or spend money, a source document must be created. So the next one is the journal. It is also known as the book of original entry, and it is the first place where any transaction is recorded in the business. And the next one is the ledger. The ledger is the principal book, and it is a set of accounts in which the financial information in the journal is summarized and posted. Then we have the trial balance, which is a list of all general ledger accounts that contains in the ledger of the business. So the last one is the financial statements. The financial statement is being divided into different or subcategories like the profit and loss account, the balance sheet. Then we have the cash flow statement and the statement of change in equity. So these are the accounting procedures that we must follow in order to prepare a meaningful financial statement. So we are looking at elements of financial statements. There are five major subcategories of a financial statement. So we have the assets, we have expenses, liabilities, equity, and revenue. So what is an asset? An asset is a resource with economic value that an individual, corporation, or country owns or control, with the expectation that it will provide future economic benefits. So assets are being divided into two types. We have the non-current assets and the current assets. Non-current assets like cars, furniture, computers, machineries, and the current asset like cash, inventories, receivables. So those are some of the assets that we must know. Then we have expenses. So expenses is a money spent or cost incurred by a company or business in their effort to generate revenue. So expenses are further divided into two, like the direct and the indirect expenses. And we further classify them into different types like administrative expense, selling and distribution, production expenses. So the next one is liability. A liability is an obligation of a company that results in the company's future sacrifice of economic benefits to other entities or business, such as debts, account payables, and income tax. Those are all liabilities. We also have equity, which is the amount the owner or shareholder will get back if the business pay off all its debts and liquidate all its assets. So the liability or the equity varies, depends on the type of business you are operating. Like limited companies, they have share capitals, meanwhile sole proprietors have capitals. Yeah, so that is equity. Then the last one is revenue. A revenue is a total amount of income generated by the sales of goods or services related to the company's primary operation. So a company can also get revenue from services like consulting, rental income, and also from the sales of its goods, and also from commission, interest received, discount received. So that is how a company gets its revenue. So thank you, and I really appreciate you for watching my videos. Please don't forget to like and subscribe so that when I post the next video, you will be able to follow up. And also remember to keep your questions in the comment sections, and I'm going to get back to them.